the thing to look at now is the comparison between an NRAS property purchase and a non-NRAS property purchase. So in other words, a more regular sort of property investment purchase. What we're looking at here is an example using one of the properties that's currently for sale on our website at the moment at Timaru Estate in Victoria. The price of the property is $289,000, and when you've got some other purchase costs there, you've got some stamp duty costs. Now these stamp duties are based upon an off-the-plan purchase, so they're lower than you would get if it was an existing property. Then you've got just various other costs associated with the purchase, so you've got about $295,000 that is the purchase price. And NRAS, non-NRAS is exactly the same. So then you're looking at the rent that you're earning from an NRAS versus a non-NRAS property. Now an NRAS property, you're giving up 20% of the rental on the property in exchange for the NRAS incentive. So you'll see here that the non-NRAS property has over $14,000 rental, whereas the NRAS property has a lower rental, just over $11,000. Now we're taking into account here a 4% occupancy. We're taking into account here a 4% occupancy or vacancy rate, should I say. Then we've got your interest payment on borrowings will be the same. Your expenses for running the property will be equivalent, and so the bottom line is there on both of those properties at this point. You're looking at a negative gearing position. Then you need to look at the tax and NRAS benefits that come in. Now the tax deductions that you get are from your deductible interest, and they're from your depreciation on the property. The big thing there's a little bit of a difference there, slightly higher in the NRAS situation because you're getting a lower income from the property. And then you've got your NRAS benefit. Now what we've done here is we've netted out the NRAS benefit. It's currently $9,140 per year as or this year as the NRAS benefit, but there are a small number of costs associated with that, and we've netted them out as an example here of $8,455. So what you find then is that when you take the tax deductions, the NRAS benefits into account, the NRAS property is actually a positive cash flow. So you've got $32 a week cash in your pocket. So you've purchased the property, you've got all your costs, and at the end of the day, you've got $32 back in your pocket. With a non-NRAS situation, is the normal thing that most property investors will see is that they've got to put some money out of their own pocket into the property on a week-by-week basis to cover your costs. And in this example, it would be $93 a week they would have to contribute in order to maintain that property. So it's a big advantage to go from to the NRAS program where you've got a positive cash flow, and we find that many people see that $93 or equivalent sort of figure of negative cash flow as an impediment to them getting into property investment, and the NRAS really is giving opportunity for lots of people who weren't previously able to get into property investment because they couldn't fund the $93 in this example. They don't need to worry about that, and therefore that they're able to get into property investment. Thanks, Rudy.
Okay, just on that, if you could just read weekly cash where it says daily cash. We'll just fix that up for next week.
Thanks, Greg.
Okay, so most of you would be aware that these figures, or most of you are aware of a 100% finance option. All of these figures are based on, and when you go to the website, and there's some fantastic reporting on the website that Ruby's going to take you through later. In all these scenarios, we're talking about 100% finance option. That is, that you're going to release 20% from another property, either your principal place of residence or another investment property, and you're going to borrow 80% against the NRAS property. And there's some terrific loans out there now for NRAS at 80%. We love 80% loans because we're not going to be using our hard-earned cash to pay, for mortgage insurance and things like that. So the 80%, 20% model works really, really well, and that's the model that we've applied right through all our own calculations here in our presentation tonight. Thanks, Ruby. So this is a graph that's already is also available on our website. Paul, just run us through this if you could, please, mate.
Yeah. So this figure is we've talked about the cash flow situation. So this is really demonstrating in the first year, and the figures run the same over 10 years. Is who pays for the ongoing costs of running the property. Excuse me. So we know with investment property, our big objective is to get capital growth. That's where we make our money. But you maintain the property over a period of time. In this situation, the scenario that I just presented to you earlier on, the people paying for the holding of the property while you're getting that capital growth, 44% is coming from the tenant, from rent. You've got the NRAS benefit giving you 32.5%, and the tax benefits are 23.1% in this example. And you can see there, you in the legend is zero. So the NRAS investor pays nothing, and the government, the NRAS benefits, the tax, the rental pays for the ongoing costs of maintaining the property while you're waiting for that capital growth to happen.
Yeah. The really interesting thing about this for us is that over the last 10 years of trying to get finance for people, and prior to that through our own circles of being in investing, is that quite a number of people are precluded from getting into property because they don't have the cash flow. They've got the equity, they know what they want to do, but they haven't got that 5 or 10 grand a year that they need to cash flow it until rent catches the interest, and you hope that the rent eventually does catch the interest. If interest rates are going up and rents aren't keeping up, then could be 5 or more years before the net rent catches the interest payment and your other costs. So what NRAS has done for some people, including some younger investors who have got some equity, or they've got some money together from parents or whatever, and they've been able to get involved, and then they're not worrying every week about getting into where they're going to get that $100 or 5 grand a year. And there's also some things that we can talk to you about that with Section 221D, which we can go over or talk to you more personally about when you contact us. But it has allowed another group of investors to get involved in property, and that's been wonderful. Thanks, Ruby. So capital growth. If we look at this equity versus cash, this would be on the Timaru example from earlier. We've taken a very conservative approach of property doubling every 10 years. We don't like people saying 7 and 8. Well, not that we don't like it. We just in some cases that happens, but 10 years is a very conservative estimate. The actual figure over the last 10 years, the annual growth rate across all residential property across Australia is 8.4. And just so while you're thinking about that, if you don't know about the rule of 72, allows you to divide the number of years into 72, and that'll give you what the percentage capital growth is. So if 10 years. 10 years comes in at divided into 72. Sorry about that. 10 years divided into 72, you come up with 7.2. Australia's been 8.4 for the last 10 years. So that's a lovely graph. You've got $270,000 worth of equity you've created, and by year 3 or 4 of the program, the cash investment is a negative, so it becomes a positive cash flow. Almost it's enough to be on the graph there, and certainly, as Paul said earlier, we're looking at cash flows on some of these properties between $30 and $100 a week from day one. So that's everyone else is paying the costs. taxman, the NRAS incentive and the tenant, and you're enjoying the capital growth. So what is NRAS? Well, we covered this off a little bit earlier, but let's just go through it again. National Rental Affordability Scheme. It is not social housing. Social housing is a different program, funded differently. Government make all the decisions. In this scheme, you make the decisions. You make choices about the property that you want to invest in. You get a choice about what tenant you're going to have in there under a means-tested arrangement, and you get lots more choices. And it's aimed at workers. In the first legislation, it was aimed at key workers. They've opened up by police, nurses, emergency workers, fire brigade, that type of thing. They've opened that up now to all workers, but it's means tested, and we'll come to a graph later that that we'll run through. It's now 35,000 dwellings. The original legislation was for 50. We've had 15,000 taken away last week as part of flood relief. What it did do, though, was have government come out, the federal government come out and confirm the program. Also, just to allay we've been asked the question a couple of times in the last couple of days, any licence that's already been granted and you have an NRAS property, the government have confirmed in their web presence that they're not going to move away from that commitment. Yes, they've backed off from 50,000 to 35,000 within the scheme, but licences that are now granted, and we're up to round 4, we'll cover that off. Round 1, 2, 3 and 4 have been conducted. We'll cover that off later, but anything that has been granted, if you've got a licence, it's there for 10 years. The government aren't going to change on that. They've just reduced the number over the next 10 years. So it's providing incentives to increase the supply of affordable housing, affordable rental dwellings, and reduce rental costs for low to middle income households, in our case by 20%. It's administered by FASIA, and that's Family and Housing Community Services and Indigenous Affairs. Very valuable website. If you go to that website, just Google FASIA, or it's .org.au, and on the right hand side you'll see National Rental Affordability Scheme. Click on that, it gives you all of the information about what we're talking about tonight. We've taken everything we're talking about here from the website as far as the scheme goes. The graphs and that we've achieved using some software that's quite common in the marketplace. So